Opendoor stock is back in focus as we head into Tuesday's pre-market. After an explosive 5-day rally that took shares to as high as $7.32 intraday, the stock finally cooled off on Monday. By the closing bell, Opendoor was down 61 cents, finishing the day at $6.04, a 9% pullback. At first glance, that kind of move might look discouraging. But here's the thing, when you zoom out and really study what happened, Monday's decline actually looks a lot healthier than it does scary. And that's what I want to spend time talking about today, because there's a big difference between a rally that breaks down and a rally that consolidates. Monday's action was consolidation, not breakdown. And the more I look at it, the more I see a base being built right around $6 that could set the stage for the next move higher. Now, one of the most important details about Monday's red session is that the decline came on reduced volume compared to last week's rally. That's crucial. When you see a stock climb on strong volume and then pull back on lighter volume, that's generally a sign of healthy price action. It means the buying pressure is still dominant, and the selling is more about traders locking in short-term gains than it is about conviction selling. If we had seen Monday's decline happen on a surge of heavy volume, that would be a warning sign. But we didn't. The opposite happened. That's why I'm looking at $6 as a very solid floor right now. And to be honest, I'm not afraid of any additional downside from here. Personally, I've said that if we do get a significant push below 6, that's when I'd look to add more to my position. That's how bullish I am on the long-term trajectory of this company. Every share I can scoop up at or near these levels is one less share in circulation, and to me, that's evaporating supply that could one day fuel a much bigger move higher. So rather than fear red days, I actually see them as opportunities. Now, let's talk about why the long-term story remains bullish, because this isn't just about price levels. There are real catalysts in the pipeline, there are activists pushing for change, and there is retail energy that simply isn't fading. First, the short interest. Right now, nearly 24% of Opendoor's float is sold short. That's around 155 million shares betting against this company. That's a huge number, and it puts Opendoor in the category of one of the most heavily shorted stocks in the market. Some of those shorts are hedging positions, convertible arbitrage strategies, and the like. But a lot of them are outright bearish bets. And when that much of a company's float is short, it creates tension. It creates rocket fuel. It creates the potential for a squeeze if momentum starts to build again. But here's the thing, and this is important, a squeeze isn't the focus. The open army has been clear about that. Yes, if shorts get caught and have to cover, it would be a nice bonus. It would be treasure along the way. But the real play here isn't squeezing shorts. It's transforming Opendoor into the Amazon of real estate. That's the mission. That's the vision. And that's what long-term holders are here for. And speaking of the open army, let's acknowledge how resilient retail sentiment has been. Monday's decline didn't break morale. If anything, it reinforced the conviction. And it's not just retail traders in the trenches anymore. We're seeing pop culture enter the mix. Comedian Rob Schneider publicly jumped into the stock and gave the movement its new rallying cry, "You can do it." It's light-hearted, yes, but it matters. Cultural moments like this keep retail engaged, they spread awareness, and they add a sense of community to the trade. And when retail feels like they're part of something bigger than just a stock ticker, that's when momentum becomes sticky. That's when dips get bought, even after a string of red candles. Of course, activism continues to be a huge part of the story. Eric Jackson has been relentless in his push for board reform at Opendoor. He shrugged off the short interest headlines, making it clear he's unfazed by bearish bets. Instead, he's keeping pressure on the board to accelerate change. He's even floated the idea of bringing high-profile figures like Drake into the movement, which, again, isn't about Drake himself so much as it is about keeping attention on the stock. The point is, Jackson is keeping the board under microscope, and retail is amplifying his message. That combination is powerful. Let's not forget Keith Rabois either. His continued connection with the company shows that there are serious Silicon Valley figures still engaged with Opendoor's future. That's reassuring, especially during this interim period where the company is still conducting a CEO search. A new CEO is one of the biggest near-term catalysts we have. The right hire could immediately re-rate this stock. It's not just a symbolic move, it's an operational one. A strong CEO could accelerate the AI pivot, sharpen execution, and open new partnerships. And that's why all eyes are on this search. The market knows it. The activists know it. And the open army knows it. Now, let's talk about the vision, because this is what makes me most bullish. The goal here is for Opendoor to become the Amazon of real estate. And when you think about what that means, it's enormous. It means building a platform where buying and selling homes becomes as seamless as ordering a product online. It means leveraging technology, data, and artificial intelligence to take friction out of one of the biggest transactions in people's lives. And it means creating a marketplace that can scale nationally, maybe even globally. That's why the upside is so massive. That's why you hear long-term targets like $82 being floated. Because when you look at the size of the housing market, Opendoor doesn't have to dominate the entire space. It just has to prove the model at scale. And if it does, the valuation potential is staggering. Now, circling back to the here and now. What should we be watching as Tuesday's session gets underway? First and foremost, it's all about $6. That level has proven to be strong support, and as long as the stock can hold above it, the bull case remains intact. If we do dip below 6, the key is whether it's on heavy volume or light volume. A light volume breach would look more like a shakeout than a breakdown. And as I said earlier, for me personally, a move below 6 would be an opportunity to add. I don't fear it. I welcome it. Because the long-term story hasn't changed. Second, we should be watching for any fresh catalysts. The CEO search, any updates on the AI strategy, activist commentary, these are the things that can ignite momentum quickly. Remember, this is a stock with a passionate retail base and high short interest. It doesn't take much to spark another run. Third, keep an eye on broader market conditions. If the market is strong, it can amplify Opendoor's recovery. If the market is weak, it could add some pressure. But again, the long-term thesis is bigger than any single trading day. So where does this leave us? It leaves us with a stock that has already proven it can rally, proven it has retail backing, and proven it has activist oversight. It leaves us with a stock that just pulled back in a healthy way, on reduced volume, to test support at $6. It leaves us with a stock that has a long list of catalysts in the pipeline, from leadership changes to macro tailwinds. And it leaves us with a community that is energized, not deterred, by volatility. That's why, heading into Tuesday's pre-market, my tone is bullish but realistic. Yes, we could see more selling pressure. Yes, we could even dip below 6 temporarily. But I don't see that as a reason to panic. I see it as a chance to strengthen positions, a chance to take more shares out of circulation, and a chance to prepare for the next move higher. Because when I look at Opendoor, I don't see a short-term trade. I see a long-term opportunity. I see a company with the potential to redefine real estate. And I see a movement that refuses to let go of that vision. So as the market opens on Tuesday, remember this, red days are part of the process. Consolidation is healthy. $6 is the line to watch. And the catalysts that matter most are still ahead of us. That's why I remain bullish. That's why I'm not afraid of volatility. And that's why I believe the best chapters of this story are still to come.